I trust you're all well, and welcome to this week's show. So as we go along, guys, please pop in questions that you have. I will periodically just check on my chat to make sure I do cover everything. Let me share my screen and we can just get cracking. So I have two markets on my watch list this morning, and I'll explain to you why I have them on the watch list. But let's just have a look at what they're doing at the moment. First one is gold. I'll look at the rest of these markets that we trade shortly. So the first one that we have on the watch list is gold. Okay. And the reason we have gold on the watch list is simply this. We've been talking about it. If you've kind of followed my short presentations on Jeff and Ash's live trading buddies, or if you followed our show, like most of you guys have, and welcome again. You know, we've been talking about levels of resistance for a while, and where I think that the bulls want to go and what the bears want to do. So if we look at this trading range here that formed, that low, that high and that low, the measured move of that is right up here. So if you are a bull and you've seen all of this price action, you're saying to yourself, if we break above that level, a bit cluttered, but if we break, let me see if I can open that up. Yeah, so if we break above that level, so that's the trading range, then you want to get to a measured move. Okay, so you have watched the candle that broke out above that level is this candle here. That's the one that broke above it, and it created a doji. Immediately be saying to yourself, if you're a trader looking for pullbacks to go long, but hang on a second. The bulls are strong. You know, they came off this micro double bottom here, which was a higher low. Okay, that low, higher low, or that low, higher low. So perfect setup. Bulls have been strong. The body started shrinking. We should be telling you there's something wrong with the bull case. But in any case, you wait for the breakout, and then you get that red line. Just ignore it. That's the low of yesterday. So when things go on to the execution list, that's when I put my low and highs. So that would have been a question mark. Then we had 3 days virtually of the bulls failing to break above the high of that doji. Whenever you see a doji, you know you are in a trading range. And if you're in a trading range, the rule is very simple on price action trading. We want to buy high and sell low. By selling low is we're taking our profits. You gotta sell out of your profits, then wait for the market to get right to the bottom. Then, did I say? Buy low, sell high. You sell high, okay, and you buy off low. So at this point, you have been trying to sell, okay? And when you get to the bottom of a trading range down here, you buy. So a trading range has been created. So when I spoke to Jeff and Ash, I kind of said, if they don't break above that, we will have a strong bear move. So I don't know if you were in the market yesterday. If you were, you would have tried your best to try and get into this trade. I did, and the day ended up, I was in a lot of trades yesterday, but yesterday was a good day. So they haven't ended the day with an outside candle. An outside candle is also an indicator, number one, of bear strength, because the bulls tried to break out above that. And then they failed to break out. The market came back, but it's closed within, still within that trading range. So you can expect buying off here, because that in itself, that outside candle is a trading range on any lower time frame. So this buying is not a surprise. But having seen that trading range formed by this candle here, because I'm not trading the daily time frame, so I'm not looking to buy as yet. I'm trading the 5-minute time frame. So today I have, I hope it's not us. So my other computer just pinged off. So today I'm looking for a break beneath here. Okay, I'm expecting that if the bears are strong, they are going to try give us a measured move of this trading range. Okay, in the day. And a measured move of that trading range will bring us to test the low of the trading range, of this 1 bar trading range. So if the bears are strong, they'll come down here. Okay, and if you're in the market, you're going to try and take your profits, at some stage. If you go beneath here and create a huge downward candle, that's a different case. But if it bounces off here, you take your profits out of the market, depending where you are in the market. Now, just on the daily, if you're a bull, there's no ways you're going to be initiating a buy trade here. So you could still be saying, okay, we didn't show enough strength as bulls in our breakout, but I know that's a trading range. And when we come back to test the breakout point here, or that measured move, and I see a bounce off here as a bull and decent reversal, 2-bar reversal, whatever the case may be, you can take that. If you trade in the daily time frame, I would put my stop at the beginning of the breakout. If we see that as 5-minute traders or any lower time frame trader, if you see a setup, then okay, again, we'll look for the entries and try and catch these moves. The goal of using the daily time frame is just trying to find, where there's a setup of the day like that, micro double bottom, 1, 2, wedge push, higher low. Then you want to go on the particular day and look to get in and try and optimize the profits. That's why we use that as our indicator. You can also use the hourly time frame. Now, I tend to use the hourly time frame only in the only when we get to after the Asian session. The Asian session is the open of the day. Not enough trading has taken place for me to get my confirmation of my direction on the hourly. But when you get to the London session, where the whole session go in, which is the open of the day. Now, understand that every session is an open, a middle, and a closing, and we trade them differently. But the whole day itself is an open, middle, and an end, and you look to trade them differently. So if you approach your trading like that, you tend to see a lot more opportunity than just seeing charts in front of you. So right now we're kind of in the middle of the day. A lot more has transpired. So if things are not clear on the 5-minute, I can just pop up the 1 hour and get my direction from there if I want to do that. So now, just a little bit more insight and looking into the 5-minute, because now we are actively trying to find trades. The beauty about price action is you're quite busy, but it's fantastic busy. So this is where we are. Now, because I am looking for shorts, I have learned my own personality not to go counter trade. Okay, so I'm not gonna, even if I see what appears to be a decent bull setup, I'm not gonna do that, because I have found, for me, once I do that, my brain cells, my brain pathways, my neural pathways all get so focused on going long that even if I manage my trades well, when it turns and becomes a bear, I don't process it fast enough. Then I hate chasing after the market. So when I say I'm looking for shorts, it does not mean that if you wanted to trade all day, you can trade as the market comes up, trade in range, trade as a trading range. tight bull channel, trade as a tight bull channel. There's many things that you could have done here. But coming off the daily setup, we are looking for shorts. So when I was looking at the market from pretty earlier on, so these are set up as I go along. When I was here, I pointed this out before. Okay, so this is the open of this present session. I'm just going to move it here. So for you guys who get up, who have the opportunity to trade the Asian session, when you are here, there's so many tails at the top, tails at the bottom. Yeah, trading range, price action. But how do you find the patterns in there? I've mentioned before, just as a reminder, that when you see that, there's absolutely no need to panic. Just pop in your line chart, okay, and things become clear. Then you do your price action based on the line chart. So at some point, you said expanding triangle top, which allows you to take a trade somewhere within there if you wanted to. You've got an expanding triangle bottom at that stage. When you pop it back to your candlestick, you can see all the tails. And then just ignore those overshoots, right? And what you're seeing is, okay, there's an expanding triangle. If you'd had a decent enough reversal here, small candle or a lower high, you could have taken the trade there. But now you get this huge bear candle to the middle of the expanding triangle. You don't want to initiate any trades in the middle of a trading range. So you wait, okay? And the market comes down here. And if you just extend that, that's what you'd have seen, okay? Expanding triangle top, expanding triangle bottom, and expanding triangle top and bottom. It's a breakout mode, one of the patterns we talk about. So you'd have seen that. So whenever you see that on any chart, just put up the timeline. I mean, you know, it's all based on closes of each candle, and closes are very important. Okay, it just removes any confusion that all the tails top and bottom affecting the market. So do not worry about that when you see it. So I had all of that. The other things, when you see a pattern like that, the market tends to want to repeat patterns. Patterns that are forming at the beginning of the day tend to be repeated. So when you see that expanding triangle, and then later on you see an expanding triangle like that, you're not shocked or surprised. And all you're waiting for is, okay, there's another expanding triangle top. If I get the bears giving me 3-4 successive candles beneath the EMA, lower high, I can trade it. Okay. Why have you moved to only one EMA? Hey, John, very good question, John. If I tell you the answer, you'll know. The EMA that I have is a 10 EMA, okay? And we use the 10 EMA to highlight the strength of a trend. So that's why I'm using it, because I want to be able to get my trades when the market is strong. Now, I then know, of course, and that's probably an unfair bias, I then know, of course, that the 20 EMA, you know, when I start to get the market kind of bouncing, you know, out of the 10 EMA, the trend is weakening. But if I get a double bottom, I kind of know there would be a 10 EMA somewhere in there. So that's a very good question. And guys, if you wanna, there's absolutely nothing wrong. That's price action trading. 20 EMA is very good use for price action trading. But I've kind of filtered out a lot of trades. Okay. There you go. So for example, I say when you get a double bottom, I kind of know there's a 20 EMA. So, you know, use it. You'll get to a stage, if you want, you can remove it. But 20 EMA is good. Then once you get out of the 20 EMA, you don't take any trades. But I'm trying to optimize the trades that I'm taking. And also, I've got 7 markets that I'm trading. That's That's something else. I used to just trade a couple of markets, I think Euro Gold and US 500. Now I've added UK 100, the derivative of the FTSE. Got oil in there, got Hang Seng 50, I got Nikkei 225. Having a lot of fun. Okay, so then we have a bigger expanding triangle. Looking for shorts at that stage, I was wedge pattern 1, 2, 3, double top. If I did a second strong bear candle closing near its low, pull back, would have taken the trade, because these patterns, when they set up, they're pretty strong. And on the bottom, I've got a continuation of, now it's a larger expanding triangle. So far what I'm seeing today on gold, the market is creating these expanding triangles. So if we get the setup that we want, we need to see always, this is the strongest part of the trend. We need to see a strong bear candle. We need to see another strong bear candle. That's a candle closing on its low. Then we get the pullback. Then we can take a trade. Okay. Now, here's what's fascinating. And have a look at it when the day ends, and let's see what happens. If the market is continuing to form larger and larger expanding triangles, if we get a setup that we're talking about here, those consecutive bear candles will tell us that the trend is weakening. Okay, there we have 3 bear candles, but the only one of significance is one that closed beneath moving average. Then it fails immediately. Okay, I want to see one closing beneath moving average and a follow through. If it takes us this kind of low, even better. Or we might just enter a trading range. But if we see that, if I'm taking the trades, I'm going to be confident to try and hold all through these levels. So you will take off some of your profits, of course, if you want to do that. Okay, take off some of your profits and hold it and see if we bounce off the low of this expanding triangle. So now we can do that from there to there. And where we turn, we can always refine it. And if this happens, and there's still plenty of time to the end of the day in the US session, you might get another bounce off, maybe to the midpoint and the resumption. So right now, looking for shorts on the euro. If you've been trading as a bull, in a tight bull channel, there's ways to trade it using limit orders. Every time it gets to here, just buy the market or buy the close of a bear candle. But we're not talking about that today. Yes, yeah. So when I say I want to see a strong bull candle, a bear candle, so let's assume this particular candle that's open. Okay, let's assume that becomes a strong bear candle for the purposes of our discussion. So it would need, it's open where it's open to close beneath the moving average. Okay, and it needs to close near its low. So even if this particular one closes where it is, yeah, that's a doji, so that's a bit of a concern. If the bears are strong, why are we not reversing the market? So we need to wait a bit more. So assume if this closes near its low, we still need the candle that closes, starts with that one closed and closes near its low beneath this 10 moving average. Then we need the follow through. The reason we need the follow through is it becomes a breakout candle, right? Every trend candle is a breakout candle. So we have a breakout now beneath moving average, good for the base. We'll have follow through that confirms our breakout. So everything is set up nicely. Now we are looking for ways to get into the market. We just wait for a pullback to test the 10 EMA, or maybe it's just a 1 bar pullback, doesn't matter. That's where we take the trade, and our stop will be here at the highest point. So that's what we're going to find. That's what you're going to look for. So now it just becomes a waiting game. Okay, that's a doji. So fine, the bulls have failed to capitalize, but we're looking for the strong back candles. The other thing, one of the patterns that we've spoken about at length is the major trend reversal. Okay, so this trend has carried on for a long time, tight bull channels, which means bouncing off the 10 EMA, very strong trend for the bulls. In that case, the significance of what I'm talking about is even highlighted further. The bears need to show that they're closing not just beneath the 10 EMA, they're closing beneath this trend line. So they're breaking the power of the bulls. And then they follow through, they close beneath this low. Then we just wait for a lower high and we take a trade and just try and hold it as much as we can. John, I'm trying to understand your question. Is that HTB high, a short of high, the session high of the day? If I understand correctly, if not, 7 candles back from where we are. Okay, 1, 2, 3, 4. Okay, here. So that's presently our high of the day. Yeah, that is presently our high of the day. So the reason we would put our stop there is simply, remember with our stops always have to be at a technical level. That I have to insist on. I don't mind if I get stopped out, which sounds maybe a little bit funny. For me, if I've put my stop in the correct level, I don't mind being stopped out, especially when I'm taking an initial trade like that. If I'm now building positions, I've trailed my stop, and I'm now saying, okay, got some money banked and this thing is going my direction. Let's try and make some good capital. I can use a tighter stop for that particular entry and see if I can just go for a quick 1-to-1. And if I get stopped out, that's fine. That can be a stop above the candle because I'm just trying to, go for the move on the candle and bank 0.5% as I go along. But when you're starting up here, from experience, if you do that, you get stopped out. If you get stopped out, let's say you put your stop here instead of there, and it gets stopped out and it turns, you just have to tell yourself, it doesn't matter. Okay, the setup is still the setup. Now it's set up the lower high that you should have waited for. Take the trade. That's perfectly fine, which is one good reason to always start off with half of your risk. So if your acceptable risk is 1%, start off with 0.5%. Okay, that just works for you. I need all the questions. Don't apologize, John. I need the questions. Guys, ask all the questions. That's the only way. I mean, like that point about the 20 EMA. I took it off because I know where it will pop up. But actually, what I should do when I come to these sessions is leave it in, because not everyone now has got that intuitive feel of where it's going to pop up. Okay, so you'd see, if we had a strong close beneath here, that's close beneath the trend line, close beneath the moving average, get another second close beneath that low, but also close beneath the 20. So please ask questions. Sometimes I make incorrect assumptions. So gold is on my short for reasons explained on the daily. Euro is the other one, which when I was on live trading buddies, we discussed at length. And I mentioned the measured move targets beneath, which are a magnet. And good to say that, what we said would happen. Remember, with price action trading, when I say it's going to happen, I'm 100% certain it's going to happen 60% of the times. So the other 40%, I'm wrong. So what I said was going to happen, 100%, 6% of the time has been happening, which is good, if you're in the market and trading. Now, here's what's interesting. I think now it's pretty evident why it would be on my short list for the day. But what I think is a strong magnet is this level here. 1.1127, thereabouts, which is the measured move of this trading range. Okay, high of this trading range, low of the trading range. The market really worked hard to try and break through that. 3 pushes down, eventually had to go up again and come back, and it's broken through it. The first time now we're having a succession of strong bear candles. I think that's a magnet that we have a 60% chance of going there. So I think that's going to pull the market down quite substantially. So I leave that in there. But then, when we were speaking, we had other measured moves based on this in here. So we got to those measured moves, and the market hasn't turned as yet, right? And when you look at it, so if you just open it, there's a lot of things that even if you were trading on the daily time frame, you could just jump in, put your stop in the correct place, and wait patiently. All day traders can wait for weeks and months. So there'll be a good opportunity for you to wait. What would you do if you're a daily trader? You'd have said, okay, I see all the measured moves, strong break beneath that, follow through, bit of a pause. If the bulls were strong at that stage, you would have had a bit of a bounce, but it didn't. Strong bear candle follow through, slightly smaller body, but closing almost near its low. So even if you just went in and said, sell at the market today, if you put your stop at the correct level up here, there's nowhere else to put the stop when you're taking that trade, because you're saying if the bears are strong, that move itself should correspond to a measured move. So let's watch the clutter a bit. So you would be saying, just on that move, it's a bit higher, the bear bodies of that breakout move, the measured move is down here. If today ends up as another big bear candle, then you just extend it. So you'll be saying, if I take a trade here and put my stop here, even if we get a pullback for the next 3 or 4 days that comes back to test that breakout point, I am going to hold on to my trade because the market will likely want to go there. Then, of course, if you have a pullback anyway, you then have to put your leg 1 equals leg 2 extension. Let's just put that in there. So let's assume from that breakout to here, if the market then turns, and if it gives us a pullback that comes back to test that level, now without that depth of a pullback, let's get a 1 bar pullback, the market can be pulled down to there. But if over the next few days we trade this one, the market comes back to test that and then gives us a micro double top, whatever 2 bar reversal here, the measured move, the earliest place to take your profits would then be here. So then you can say, okay, if the trend resumes, I'll take half of my profits here and leave half in case we do get to the first measured move. So that's the kind of thinking that you could apply. And remember, it's, markets are fractal, patterns are fractal. So you just, same thing and repeats on each time frame. Today's high, yesterday's high, yesterday's low, measured move is here. And that first blue line is 50% extension of yesterday's height. Okay, so just when you then go, so I've got euro on a sell. I'm just waiting to see how I can get into euro. Now, so here's where we are. I'll go back to what happened in the Asian session right now. So here's where we are presently. That wedge, market went up to try and test the low of yesterday, failed. Bulls were strong enough to break out above it. But look at the follow-through candle, failed. So the bulls don't have enough pressure to break out completely at this stage. Okay. Tried again. Now they've gone above the low of yesterday. They're trying to go for the open, today's open, because that's the next level of resistance. Okay, which kind of corresponds with the breakout point here. Immediate reversal came back beneath the low of the day. Bulls had a chance at that stage to carry on with the breakout, but they failed. Okay, so now we've got a trading range created, low, high. And when you get back to the top of the trading range, attempt to break above it, fails, comes back, attempt to break above it, fails, and almost a perfect test of the open of the day. Then the bears were back in the market again. Okay, so right now we are within this trading range, this low here. Okay, this low here. Of course, there's other lows there. And this upper level, resistance level, which is today's open. So very significant. If the bears are going to control the day, they really can't allow the market to go above the open of the day and then the present high of the day, because then you start to say, hang on a second. So the bears are not that strong. So now the market is going to turn. Then, we have to just assess carefully the way we trade. Now we'll be trading just a trading range. So euro definitely on a sell. I'm waiting now. If the market comes back up to test the open again and we get a double top of that open, then I want to see off that double top strong bear candles. Okay, 2 or 3 strong bear candles as trend candles closing on their low. The 1 or 2 big ones or a succession, fantastic. I want to see them closing beneath, because we've gone below and above, close beneath the low of yesterday, and then come back, test it, and if I get a decent reversal, we're just going to trade that. I mean, there's a lot of opportunity to get down to this low where we might expect to find bulls trying to make the whole thing fail. Now, what's interesting is with euro on a sell, okay? So if you're up trading the Asian session, or it depends where you are, it could be end of the day, but if you're trading the Asian session as your session, what you see in here would have given you opportunities to trade, okay? And here's why I say that. Because you want to go short, or even if you're going long, the key indicator that you got to look for is the strong candles, okay? Strong bear candles, you got to look for your patterns. Everything has to be clear. Just bite your fingers, stand back, sit back, go for a walk, do whatever. Even if you miss something when you're just cooling your mind down, you got to see the pattern. When you see the pattern, then you see the execution. Okay. So even started off, early in the morning, there would have been nothing for you to take here. You're observing to see where the bear strength is. Okay. Then you do see bear candles, nothing very strong here, but there we had our first test, first attempt to break beneath to a new low. This is low of yesterday. That failed. Fantastic. It does not change what we're looking for. That would have been your top and your high that are key at the moment as the market turns. You get to this point, you'd be expecting 60% of chance, of course, because you want to go short, the market to bounce off that. You don't ignore what you see in here. This just says to you, if you see a double top, fantastic. I have to wait to see the lower high, which is why I keep trying to repeat that you got to see the pattern that says, this is the pattern I'm going to trade. Then I got to see the lower high, the higher low. That's what I'm going to execute. The pattern must be clear first. So that would have been a nice double top for you to have noted. At that stage, you'd have been saying, brilliant. That's what I want the bears to do. Give me another follow-through candle, which they failed to do. If they'd given you another follow-through candle like this, closing near its low, then all you want from this pattern, all you want is your execution, which is in a lower high. And we have waited to see what's happening. But in any case, that didn't happen. But it's still one push up, another push up. Are we going to get a third push up? At that stage, you had that doji price, bar by bar analysis. That would have been a lower high double top. Not a good one because it's a doji candle. So you really need to see bear strength. And that fails again. Market went up once, came back, went up a third time, and it did a reversal. Now, what you observe here is important. The power of these forces that come together to create entries for us is something that we just need to play in our minds. A double top is very powerful. We get a low high, we execute. The double top fails, and we get another break above a double top and a pullback, we now have a wedge or a 3 push pattern. Market went up once, went up twice, it's gone up a third time. So now if the market had turned here, we can start to look to execute. We get three push patterns, multiple forces acting against the market trying to break above a level. Market's going to break. Just, they're going to get away from this open and demonstrate strength, but they're failing. Then when you get this reversal candle here, you can notice there's also a micro wedge in here. Market is gone up. So every time I talk wedge or 3 push, I'm talking about the 3 forces that are coming together to act at the last point. Very, very important. So there's 1, 2, 3. So again, you have a bigger wedge, 1, 2, 3, this break above that and fail, and a micro wedge, which means this is a very strong level of resistance that has come up. So having seen that up now, you have multiple forces there. You gotta just wait for a lower high to trade and see if you can get the opportunity. And again, the key for me is to always look for those strong bear candles. We had one here, and then we had nothing else. Bear, bull, bear, bull. So it's trading range price action. We then get a lower high here, closing on the moving average. And so that's a lower high. Now you can start to say, okay, where do I start to take a trade? Best to wait to get that close beneath the moving average, and preferably close beneath this low. So if you take this trade in the correct place, but remember, market has been put in 3 push patterns, 1, 2, 3, 1, 2, 3. There might yet be another move. Okay, so where you want to put your stop is a measured move of the trading range. That low, that high, that low, that's the measured move. So if the market breaks above that, it might make a measured move. So put your stop just above that. That's 12 pips, okay, 16 pips. So that's where you put your stop. You can put your stop there, but if you get stopped out, be prepared to go again if it sets up, right? So always above the technical level or a measured move of a trading range. So I wouldn't have taken that, although it's a low high setting up well. I want to see a close beneath that. We then get the close with this outside candle, okay? There is a big market down here. Very happy to take that trade. You can put your stop here, outside candle, because it's from its own trading range, so above that or above that. And then at that stage, you got to wait to see. If you put in 2 trades, you can take one off at a half, whatever it is. If you trade managing, which is what I prefer doing if I'm in front of the charts, is just observe and see, okay, I can take part of the profits here. This was a surprise candle. I mean, I don't know how long this formed, how long it took, whether it was in the first minute, just after close, etc. But this was a surprise, which for me is always interesting. You see not this scale of candles, but you see breakouts beneath a significant low quite often. That's why I prefer, if I'm in the market, to manage my trades. By this time you can move your stops to break even, because as beautiful as it is going down, it could have been going up as well. If you get stopped out, having come all the way down, you at least get stopped out at break even. So there's nothing that anyone could have done here. One thing you should avoid doing when you see a candle of this nature is just jump in when it's still open or when it's closed to think it's going to form. It's just a breakout. Now you gotta wait, restart your thing and say, well, let me see what's going to happen when you get to the 50% pullback, etc. but that's just buying into the close, just shows very strong bulls. Why would they be buying here? Remember, when we're looking at our daily time frame, this is the 15 minute. This is the 50% extension of yesterday's range. So it's invisible unless you put it in when you plug your daily, when you do your daily analysis. Okay, so it's that kind of level. Unless you put it in, you're not going to see it. And you're going to wonder, but why would the market ever do that? Okay, so the market does things pretty logically from a price action perspective. So that's a very strong level of support there. So if we do get the setup, okay, where would we be taking our profits? Remember, whenever you see tails and it's like, what do I do? Just take away the stress from yourself. Just pop up your timeline. Closes are very important. So if we get triggered up here, this is a place we want to be taking profits because there is likely to be a pullback of sorts before there's any continuation. Now, very quickly, guys, today the show is now 45 minutes, so we will be just cutting off soon. Why don't I have any of the others on my watch list? The UK 100, it's a derivative of the FTSE 100, but same patterns. Though that's an outside candle, beautiful to be looking for shorts. The problem is this channel here. We're right next to the channel. So I didn't put it in because I'm expecting at the bottom of the channel that the market may bounce and resume up. So what I want to see is, where does the day end? Okay, where does today end? If the day closes beneath here, then we can look for trades on a 5-minute time frame just to go for that particular low. But we have spoken about this in our show as well. Oil, Brent crude, no setup. Now, I'm saying no setup for us to go and look on the 5-minute time frame. We want to find those setups that will end up giving this strong move so that we can maximize our profit on the lower time frame. Hang Seng 50. Now, remember I spoke about on gold, how the market has been doing expanding triangles, and we've seen levels of resistance at the top, level of support. Hang Seng 50 is doing a converging triangle. A converging triangle is breakout mode. So if the market gets up here, like a DDF gets up here. In fact, we spoke about this when we were talking, I think, in live trading parties as well. And we say there's opportunities there. That's what you want to find. Look for failed breakouts when you go to the 5-minute and trade down there. So if it gets up here, okay, or if it gets down here without giving us any other opportunity to trade in 5 minutes, we have to look for trades when it bounces off here or bounces off there. So this is beautiful, in terms of what's been set up there. Nikkei 225. So this for me, double top is interesting. I don't like the fact that it's just a bull candle. I'd have loved to see even a small bear candle for us to go and look for shorts. Remember, we trade in 5 minutes, trying to find a quick advantage and go and optimize our trades. Or if today we end up with a doji candle, then we know the bulls have failed and we can look for shorts. Okay, in just the last minute, let me just put this on the daily. Okay, so this is the US 500. Not on the watch list. Good to watch that level of resistance. If I get a bear candle in for today, it's going to go definitely for the watch list to see if we get down here. All right, guys, so we are done. Gold is starting to move in our direction. So remember, we're speaking of just when we started that if you get a candle closing beneath its low, if this candle here had been a bear candle as well, closing beneath its low, then we're good to go for a bounce. But that doji is a bit of a problem. So what might happen if you're watching this? We might get a wedge, first push, second push, a bounce off here, a resumption, a lower high. So if you get a wedge push pattern, even though there's bull legs, then a lower high will trade it. So keep it up on the short. Excellent, guys. Thank you very much. We'll catch up next week. Remember, our show is now 45 minutes, nice and punchy. Keep all the questions coming and look to see you guys. Thanks a lot. Cheers, guys. Thanks.